Thank you for joining us at XM.com. This is the weekly outlook. Recession has been the word on investors' mind recently, and this upcoming week has crucial data coming up that could determine how central banks will act moving forward. I'm Cristina Marujos. Helping me unfold this week ahead is our senior investment analyst, Mario Hadjikyriacos. Mario, starting with the United States, CPI inflation data is expected on Wednesday, and it looks like the July print is going to be another strong one. How could that affect the Fed's tightening cycle?
Hello, Christina. Well, let's take a step back. We've seen this huge debate in the markets lately. Has inflation peaked? Are we heading into a recession? And what does that mean for the Fed? So every time we see stronger data, the markets are pricing in faster rate increases, and every time we get a recessionary data, the markets are pricing out rate increases. And lately, Christina, the recession alarmists have been winning this battle. So we've seen a barrage of leading indicators, business surveys, inventories, housing, consumer confidence, the yield curve inverting, everything warning that a recession is actually imminent. And this led to a very sharp decline in US Treasury yields, which of course helped bring the yen back from the dead. But the funny part, Christina, is the dollar didn't really lose its shine. You would have expected the dollar to retreat substantially when the markets are pricing out the Fed tightening, but that didn't really happen. And the reason, I believe, this resilience boils down to a couple of factors. The first one being safe haven flows. If we are concerned that the global economy is heading into a recession, the reserve currency usually wins. And the second reason has been a lack of alternatives. So let's take Europe, for example. It's probably in worse shape than America. If there is going to be a global recession, Europe is going to be at the epicenter of that because of the energy crisis. And so do you really want to be positioned in the euro? Now, bearing all of this in mind, we're going to get inflation data this week. And I think we could see a retracement in the dollar. So the trend is still positive, but we might see, so the markets are expecting a cool down in US inflation. The yearly CPI rate is expected to go down from 9.1% down to 8.9%. It doesn't sound like a lot, but at least it will signal that inflation has peaked, right? And I'm in the camp that is looking for a softer than expected number. So if we look at business surveys, for example, the S&P Global PMI, it showed that American companies raised their selling prices at the slowest pace since last March because demand was weakening. And we've also seen a very significant weakening in commodity prices. We've seen everything from gasoline to food has rolled over lately, and that hopefully is going to show up in inflation. Prices are still very high, but the rate of increase has slowed down, and that's how we measure inflation. So, bearing all of this in mind, the markets right now are pricing in around even chances as to whether the Fed will raise interest rates by 50 basis points or 75 basis points in September. If we do get a softer than expected inflation print, that could tip the scales towards 50 basis points, and that could inflict some damage on the US dollar, I believe, Christina. But I also believe that it's going to be a retracement in that uptrend. So we are still in an uptrend. If you look at the euro dollar, for example, we're trading at around 102 right now. Even if it rallies all the way up to 105, which is 300 pips away, that's still a downtrend.
I see. Marios, let's cross into the United Kingdom now. GDP data for Q2 are also on the calendar this upcoming week, and expectations are quite pessimistic, especially after yesterday's Bank of England meeting, where despite the 50 basis point rate hike, policymakers painted a rather gloomy outlook for the economy moving forward. Could the data this week affect the pound at all?
I think it could. So here's what was really funny about the Bank of England. The Bank of England raised interest rates by 50 basis points, but they also their forecasts pointed to the economy contracting for 5 consecutive quarters, starting in the final quarter of this year. So the Bank of England raised interest rates, but it said, yeah, we are expecting a year-long recession next year. So it's a really fun situation because why would you be raising interest rates so dramatically if you are expecting so much demand destruction? But in any case, we digress. The real point is the following. I don't think the pound is really going to be affected by what the Bank of England does moving forward. The markets already have a really good idea of what the Bank of England is going to do. They're going to raise interest rates at a slow pace, and they're going to be very mindful of recession risks. That much is clear. What is really going to affect the pound, I believe, is global risk sentiment. What does the stock market do? The pound has, and cable especially, has a very strong correlation to stock markets. And the reason is the UK has twin deficits, a trade deficit and a government deficit. The British economy is also very sensitive to how global capital flows perform, essentially. So here's a good way to think about it. We've seen a huge relief rally in the stock market. That has also helped the pound to rally, or to at least, it was a relief rally. The key question is the following. Does the stock market keep going up from here, or was this a bear market rally? That's going to determine how the pound performs moving forward.
Marios, thank you so much. This was the Weekly Outlook here at xm.com.